Hello, my name is Geoff Wilson and welcome to the WAM Income Maximiser webinar. I'll be giving you a little introduction at the start and then I'll pass over to the people that are actually managing this new pool of capital. That's Matt and Damien, and then April from the comms area. April will be running the Q&A. Look, thank you already. Like, there's a lot of people that have that are already on this webinar, and we've already got a lot of good questions that have been sent in. If you have any more questions, please send them in. I mean, you all know why we create a WAM Income Maximiser. We've been looking at a product that gives monthly income, fully franked monthly income for a number of years due to significant shareholder demand. You've probably heard me say before, but the latter part of last year, when we did a survey, I think about 63% of shareholders said, look, they're looking for a product like this. The beautiful thing about WAM Income Maximiser that everyone who's put money in during the IPO is now making some money. WAM Income Maximiser, I think because when we raised the money, it was a very volatile time. We had the Trump tantrum or tariff tantrum by the stock market. There was a lot of nervousness and pretty much like as Paul Keating said years ago, and I think Ange Podger, Ange Podger, whatever his surname is. The great soccer coach said last night, when his team won, this is one for the true believers. So, it's I think everyone who's invested in Income Maximiser are pleased and are looking forward to continued growth. Dividends being received on a monthly basis once we start paying the dividends, and that's the latter part of this year. A growing stream of fully franked dividends. In terms of taking you through the workings of the company, now I'll pass over to Matt and Damien, who are in the next room, but and we'll take you through the next part of the presentation. Thank you.
Great. Thanks very much, Geoff, and thanks everyone for your time. What we might do is just talk a little bit about how the world has changed since the last time we met, and then we'll give you a bit of an update in terms of how we're actually tracking in this slightly more volatile world. So in terms of economics, if we could just kind of go to slide 5. One of the key things is, of course, interest rates have been cut. They've been cut here by 50 basis points down to about 3.85%. And what you're finding from the Reserve Bank in terms of its rhetoric is that it's probably going to cut further. So it wouldn't surprise us at all to see the cash rate, say, around 3.6, maybe even lower than that, in the next few months. Obviously, that has relevance for us when it comes to Income Maximiser, given that we are looking to get a premium over the cash rate. But in terms of why the RBA is doing this, I suppose there are a few things that stand out. First, it's pretty clear that the RBA has a view that even on purely domestic factors, so stripping out all the things that are happening globally, even on domestic factors, there is a case to get interest rates to a less restrictive and a much more neutral level. And if we run through some of the frameworks and the models that we think the RBA would be cognizant of, you get a number around the 3.5% mark as to where things would settle. And if you got, say, a sharp slowdown as they are expecting, maybe you could see rates fall below that. But if you don't believe that there will be much more slowing, then obviously 3.5 would kind of be where it would settle. So we're looking at a cash rate that will be sort of mid to low 3s is kind of our base case. What that means in turn is that when we're looking at screening the investable universe, obviously we're looking to get the cash rate plus 2.5%. It means that we should be exercising a bit of caution in the way that we look at just straight dividend yields. It means that, well, there might be stocks that aren't necessarily offering the highest yield in the world, but maybe we're going into a world like the RBA is picturing, where there's a little bit more turbulence, a little bit more volatility, and we just have to be a bit more mindful of quality. So these are the various ways in which the signal that we're getting from the central bank matters. But I might hand it over to Matt just to talk about, oh, actually, before I do that, if we go to slide 7, I might give you some examples as to how this is actually playing out in the way that we're thinking about the portfolio. So as we've said from the outset, our approach to investing in equities is very much driven by a holistic definition of income. So we're not just interested in the people and the companies that were paying dividends yesterday. We're not just interested in the high dividend payers from yesterday's newspaper. We're also interested in the companies that can offer us dividends or distributions in the future. And so this is where having an eye on quality really matters, because you might see a sheet that says that, look, this company is offering you a really high dividend yield, et cetera, but why aren't we there? It's because if the central bank is cutting interest rates, it is a bit of a cautionary sign that maybe we should be trying to separate out the wheat from the chaff and look at companies that can sustainably pay out their dividends, or maybe even grow their dividends into that backdrop. Now, just to recap, our holistic definition of income takes into account free cash flow generation. It takes into account the sustainability and the quality of earnings. It takes into account what dividend yields were yesterday, and we are also looking for buybacks. When we look at the world as it is, there is a lot of uncertainty, but one of the interesting things that's happening is that China's borrowing costs have fallen significantly, and Chinese policymakers are now in the process of stimulating their economy. You also have a bit of concern about diversification in portfolios, and some people are thinking that maybe you can find that in commodities. So a really high yielding name that we think is quite interesting at the moment is, of course, a mining name like Rio Tinto. So that would screen very well on conventional metrics that most income funds would follow. But a slightly left of center name might be something like CSL. CSL does not offer you a particularly high dividend, but it does have tremendous free cash flow generation. It does have the ability to sustain and maybe grow this in the next little while. And most importantly, with that free cash flow, it might not choose to do dividends. It might instead do buybacks. So that's just a bit of a working example as to how we apply our holistic process to try to pick stocks that we think are appropriate for the times. But certainly, as the RBA is cutting interest rates, we need to be wary of the signal that's actually coming from that. I might just hand it over to Matt then to talk about how Income Maximiser is going in its first month.
Yeah, thanks, Damien, and thanks for everyone joining. And like Geoff said, the true believers, we do appreciate your support through a very volatile period. But again, like as we said, this product was designed for these types of environments, and that's why I'm pleased to give the update today around the opportunities we've been managed to deploy the capital into while we have this turmoil in the background. And it's really on the debt side, we've been able to deploy that much quicker than we expected. We're way ahead of our expectations of where we would be sitting. When we did the presentation, we talked about 6 months being deployed. I can now tell you we're fully deployed on the debt side within 4 weeks. So it's been an amazing opportunity, and we've actually benefited from spreads narrowing after the volatility. So that is way ahead of schedule. We were 75% invested by the 7th of May. And as of the 14th of May, we were 90% invested. So I'd largely call the 14th of May fully invested. So we've been ahead of schedule. Probably the important distinction, though, is the risk within the portfolio. We have a much reduced equity exposure. Despite equities doing very well recently, we think that is overextended now. So on an asset allocation basis, we are roughly 60% debt and 40% equity. And the debt is comprised of, call it 50% of the tier twos, 10% in hybrids, which are still available and giving us good yield and franking, and the remainder 40% is in equity. So very conservatively positioned. Obviously people saw market sell off last night. That is one of the reasons why we have been on the conservative side, because you're getting a bit of a global rates push up at the moment, which is tied back to a lot of uncertainty around policy decisions, especially in the US. There is a bit of degree of skepticism around the fiscal restraint in place and the amount of duration that needs to be issued, so the amount of paper that needs to be issued over the next period as well. So yields are on the rise, but we don't think that's a long-term phenomenon. We think it's going to be shorter term. So again, we're looking for opportunities tactically to profit from the rise in rates in the short term. So, we've done a few trades recently on tactical trades in government bonds, trying to capture some of the movements in yields, which we've successfully done. And again, we're in the process of implementing some tactical hedges, increasing duration into this rate sell-off at the moment. So for us, being pleasantly surprised on the speed of execution, we've been able to get the money to work. And what that means is we've been able to generate a lot more income than previously we thought, and a lot more income at a higher rate than we previously would have envisaged. Because when we went around on the IPO, we were talking about putting the money into short-term NCDs or term deposits. We've been dealing very heavily in the secondary market to get the funds deployed at those advantageous spreads. So again, way ahead of schedule. It's been a pleasant surprise for us, and we hope we can show that through the income generated over the next period when we come out with our NTAs, when we give you an update on the income generated, and then obviously as we go into the period around August where we pay and declare a dividend. So as we sit, both of us pleasantly surprised, ahead of expectations, and the opportunity sets in front of us have been a huge surprise to the upside as well. So despite the volatility, we think we're positioned well. I'd say we're positioned defensively with equities down at a lower allocation at that 40% level. But again, this is the beauty of the product. We have the ability to be more dynamic on asset allocation. And again, we're looking for opportunities of when we deploy or wind up the equity allocation, but we just can't see it in the very short term. So with that, I think that's about it for the wrap up of the portfolio. So have we got the Q&A now? I think we can happy to go to Q&A where we can take questions around the fund and deployment. So thank you.
Thanks, Matt and Damien. And thank you, everyone, for submitting your webinar questions. We'll kick off. So we had a few that were submitted ahead of time. The first question is on markets and the portfolio. Looking to the year ahead, if trade negotiations between the US and China destabilise further, what impact could this have on the US and Australian stock markets?
Yeah, that's a great question. So most people would think that if there is another round of shock tariffs or, the 90 days of pause suddenly morphs back into what it was, that obviously you'd get a little bit of risk aversion set into markets. What complicates this is that there's a little bit of concern about just having US dollar assets among large global pension funds at the moment. It doesn't need to be taken to extremes, but there is a little bit of a concern there. Ironically, this is actually very positive for Australia because to the extent that people are concerned about the fiscal and debt sustainability dynamics that are going on in the US, well, you have exactly the same concerns happening in Japan. Europe is not really an area which has a lot of growth, but the course of this year so far has been viewed as a safe haven, a place to rotate into. China at the moment, people have a few question marks, even though we are quite optimistic. But the net result of that is that actually a lot of money goes into the closest, safest neighbour, and that's actually Australia. And so we're seeing a lot of flow into the Australian market. Now, this is a great problem to have because what it means is that a lot of global funds are putting their money in the index, essentially at cap weights. And you can see this with some of the large names that are very liquid but yet expensive, actually getting even more stretched on valuation. So it's a great problem to have. It means that our market is generally supported and generally viewed as defensive and quality in the broader landscape. The only question is, if you do get destabilization happening in US-China trade relations, how much of a negative impact would that have on China? Maybe not that much at all if it becomes the catalyst for China to really do something about their economy. So that's broadly how we look at it. In terms of, I've just spoken largely at an equity level, but at a government bond level and a corporate debt level, it's actually really good news. Because what it means is that Australian paper is in demand. And of course, debt ranks more highly in terms of safety than equity on average. And so we should expect to see quite a strong bid for those sorts of assets. So we actually look at potential destabilization. Yes, it's a risk, but we think that if you've got a sufficiently well-adjusted portfolio, including debt, actually you could do quite well out of this.
Thanks, Damien. And we have a few questions on the dividend and capital gains that are to be expected. Can you please remind us when the first dividend payment of WAM Income Maximiser will occur?
Yep. So the first dividend will be declared and paid in August. That's the plan. And obviously we've deployed the funds. The income will be largely coming through in June, July. So we're in a very good position for that August date.
Great. Thanks, Matt. And is the expected dividend in August likely to be in the expected range of that 6.6%, or is it too early to predict the actual income return at this stage?
Again, the dividend will be a board decision. So when the board meet, they can work out what is in the the profit reserve, the income that we've received, and it will be a board decision. But I think on a yield basis, we are around the 6% from memory.
Yeah, that's right. We're in the high 5s to 6s in terms of actual yield, but that's looking at today's yields. The time that we bought in, the yields were quite a bit higher than that. So what that means is that the running yield, yes, might look like it's in 5s and 6s, but there might have actually been some capital growth to think about as well, but that's a board decision.
Yeah, and then obviously during the year we have the capital appreciation, which can add to the running yield, but the running yield is quite solid at the moment, as we position into the market.
Great to hear. And again, this question is more of a board decision, but it would be good to get your perspective on it. Would you ever pay a special dividend?
Well, I can give my perspective because I'm chairman of the board. April, but I can only give it. I'm only one board member, so in terms of there's 4 people on the board, 2 independents, myself and Kate being non-independents. And when we talk about capital management, it's we need everyone on to agree to what we do. So could there be a special dividend? That's possible. Is it likely to be a dividend? A special dividend? It really depends on the performance of the portfolio. Now, normally what we'd like to do is to have a growing stream of dividends, and rather than having it having a lumpy dividend being a special one, to gently increase the dividend. And do that over time. That would be probably the strategy. But I can't rule out the fact that there won't be a special dividend at various points in time.
Thanks, Geoff. Another investor has asked, what are the benefits of investing now as opposed to waiting until the first dividend gets paid in August?
Hey, whoever. Do you want to direct them, April, or?
Yeah, sure. Maybe we'll go to you on this one, Geoff.
Okay. That's a difficult decision to answer. Oh, sorry, difficult question to answer, and it's a difficult decision to make because currently, the share price is trading at a premium to the value of the assets. Unfortunately, I can't tell you how it'll be trading, when the dividend's announced. So it's very difficult.
And hopefully the NTA will continue to increase with all the solid investments that the team have been making. Yeah, Matt, did you have anything to add?
I guess like if I was looking from the outside, I'd be like, the big risk was the deployment of funds into the market. When we went to market, we were talking about 3 to 6 months for the debt portfolio. Equities we could get set pretty quickly. We said 2 to 4 weeks. We've come way ahead of schedule or expectation. So for me, it's essentially de-risked from the deployment point of view. So for me, I think some people said I'd rather hold off, wait. Which was probably fair on the deployment side, but now we're fully deployed, at very good levels on the debt side. So I think for me, the risk around deployment or the duration of deployment has been well and truly beaten. So I think that risk is obviously out now, but obviously there's market risk. So again, like Geoff said, it's really your view on the market. I just would say, if you're looking at WMX portfolio, it's very defensively positioned. So 60% debt, 40% equity. And again, the person can make their call on direction of markets at this point in time.
Yeah, the other thing is that genuine income-based LICs are generally trading at a premium still. So there is still a strong demand for income-based products. And we feel that the macro environment is still conducive to that, given that there is still a lot of crowding in some of the longer duration growth names that people have favoured in the last few years.
Yeah, and Damien, I think you couldn't have been more clear on that when we were at our previous webinars and discussions with people and questions that there'd been. And one of the reasons we created this product because of the significant demand for yielding products, and then another tailwind, which we have in this product is. And I think someone, during, over the last few months has, described it as what was that word? Is it a super hybrid or
enhanced hybrid?
Yeah.
An enhanced hybrid. And we've got the situation where, the billions and billions of dollars worth of hybrids that are listed on the stock market are, slowly expiring. And there's $5 billion worth of hybrids that aren't going to be renewed this year, and another $5 billion next year, and there's $44 billion in total. So for the next 6 or 7 years, people will be continuing to look. The ones that are used to investing in the stock market, are you looking for yield, and this obviously fits in beautifully.
Thanks, Geoff. While we're actually on the topic of hybrids, how does WAM, this may be for Matt and Damien, how does WAM Income Maximiser compare with traditional bank hybrids in terms of risk, interest rates, and income stability?
Sure. From a risk perspective, I mean, it's a bit hard to judge. You're really not comparing apples and apples here from a risk perspective. I guess the benefit of WMX is the diversification benefits. But on the it's really hard to make a really definitive statement around risk. So we'll probably leave that one around risk, but I'd just say there is diversification benefits.
Yeah, absolutely. I mean, when you're buying a bank hybrid, if you wanted to replicate that without actually having the hybrid, you'd be buying bank debt and buying bank equity. But our equity portfolio is pretty well diversified beyond banks. So that means there is a lower risk profile attached to the equity component that you would include in a hybrid package. And for that matter, our debt portfolio has some degree of diversification as well within that. The other thing to note with a lot of hybrids is that they're pure floating rate notes. So as interest rates go up and down, the yields that you'll get on the hybrid go up and down. Because of the fact that we have a longer duration than the average hybrid, so our benchmark portfolio has a duration of about 2 to 3 years. That means that as interest rates fall, there should actually be a cushioning effect. So, our fund's only been around for a little while, so you can only work out historical comparisons with a very limited sample of data. But hopefully that gives a bit of a flavour for why the extra sophistication within WMX actually makes this an attractive product for anybody who's seeking a hybrid replacement or enhancement.
Yeah, I mean, that's a very important point around the interest rate risk. Obviously, with a hybrid, you're exposed to floating rates. Within WMX, we're managing that interest rate risk for you, and we're using duration overlays on some of our floating rate paper as well. So again, we're managing that interest rate risk for people.
Thanks, Matt and Damien. This next question is for Geoff, and it's on franking credits. Will monthly dividends be fully franked from the outset, or will franking build gradually?
Yeah, it really depends on whether we make profit in this period to June 30. Obviously, assuming there's no big profit made in this short period of time before June 30, then the logic is that the franking of the dividends will grow over time. And I think during the IPO we were talking about that 40 to 60% franked initially, and then growing over time to get to fully franked.
Thanks, Geoff. And we've got another question for you. It's whether the IPO was fully subscribed. And actually, Fred's asked a similar question. He was wondering if it wasn't fully subscribed, will more shares be issued as part of a dividend reinvestment plan?
Yeah, no, the IPO wasn't fully subscribed due to the volatility in the market. Then only the true believers invested, and they've been rewarded, from the performance of the underlying company, in terms of its share price. But in terms of the shares that we didn't issue, well, they're not used. Like in theory, they sort of expire worthless broadly, because they weren't issued. And in terms of the DRP, like we will have a DRP. We have flexibility to buy back the shares we issue under the DRP, but the DRP you can take, it will only be a function of the size of the dividend that we pay. Now, in terms of will we continue to grow the company over time? The plan would be, yes, to continue to grow the company over time. But that's really, we've got to perform for that to happen.
Thanks, Geoff. And the next question is for Matt and Damien. On the equity side, do you own similar companies in the WAM Leaders or the WAM Capital portfolios?
I guess we're looking at the same universe. I mean, within WAM Leaders is ASX 200 and WAM Capital is ASX 300. So there is obvious crossover. It's just the application is a bit different, or the starting point is a bit different around the selection process. So we have a filter which is used only on WMX to generate the universe, and then we apply all the same methods we've been applying within WAM for since inception. So the crossover probably is higher with the WAM Leaders portfolio because of ultimately we're looking at high quality companies. So with high quality generally comes size. So it has a bit of a tilt towards the top 100 companies. In fact, I don't think there's much outside the top 100 at this point in time. So again, it's got a very high quality, so it naturally lends itself to more WAM Leaders. But the portfolio is managed as a separate pool of capital with the screening process, really the driver of the differences within the portfolios.
I mean, we have to, again, it's a holistic definition of income. So when we look at the WMX portfolio, whether we're investing in high yield companies or lower yield companies, we have to be able to say to ourselves at the end of the day, they're going to pay out cash to us in excess of what they need. So we care about ultimately what they will be paying out. Even if they're not paying it out yesterday, if they're doing it tomorrow, we care about that. Whereas with the other funds like Leaders, we're not so picky in terms of whether the return's coming from distributions and income or capital growth. So there's a little bit, I mean, obviously that's a constraint that we impose on WMX to suit shareholder needs, but that does result in some difference, particularly when it comes to weighting stocks as well. So they're not identical portfolios.
Thank you. And this one's for Matt. do you have the capacity to be managing both the WAM Income Maximiser and the WAM Leaders portfolios?
The answer is yes, but obviously Damien's here as well, and we have the broader investment team, so it's just not a one-person show or a two-person show. There's a big investment team here. In reality, the way we've been managing WAM Leaders, and when I was in WAM Capital, it really hasn't changed. So we look at all the same information regardless of asset class. So both Damien and I have been surprised to the upside on the synergies, I guess, of having this information being plugged into the information flow on the debt side, which we were watching, but obviously not at the level of detail we are now, and the access. So we have all the major investment banks, all the big four trading desks getting information. Actually, we're both pleasantly surprised on the synergies from having the debt side. And again, when we manage equities, we're looking at all the same factors everyone looks at on the debt side too. So, it's not more work from a thought process. There is a little bit more on execution, but again, we've got help on execution as well. And again, probably the biggest thing, not so much related to the question, but the active opportunities on the debt side have surprised to the upside for us as well. The tactical, it's very much like the equity side, but we're highly active on equity, but we're highly active on debt now, and that's surprised to the upside from where we thought. There's a lot of opportunity to be made because, again, on the debt side, there's a lot of the street are very passive on how they work their portfolios, which is fine. They've got strict benchmarks, but again, we're happy to take trading opportunities and tactical opportunities on the debt side. Probably, and saying the opportunities is greater than we thought. So that's been a great surprise.
Thanks, Matt. And the next question's for Geoff, and we covered off a little bit earlier, but since WAM Income Maximiser is trading at a premium to its net tangible assets, do you expect that this will persist, or do you think there'll be an opportunity to buy at a discount at some point?
Yeah, unfortunately, it's like guessing what the equity market will do. You just unfortunately you just don't know. The risk is it goes to a bigger premium once it starts paying the dividends, and as Damien said, other similar-ish products are trading at bigger premiums than we are. To me, it's or then there could be a bit of volatility in the market, a bit of a market shakeout, and it could trade back to NTA. So it's very, very difficult to assess.
Thanks, Geoff. And we've got some questions coming through on dividends. So, Geoff, as chairman of the board, can you comment on a few of these? When is the cut-off date for the first dividend?
That's a good question.
So I think in terms of timing as well, the ex-dividend, I think we normally announce it like early in the month, early to mid, and then we pay it at the end of the month, just for a little bit of context.
Yeah, but in theory, so then if it's paid at the end of the month, or does it go ex-dividend to the end of the month?
Ex-dividend early to mid-month is typically how it works for the other LICs as well. Okay.
Yeah. So to me, it's a good question, and obviously from a board's perspective, we've got to work out what that is, because particularly when we're paying dividends monthly, once we, one thing we will give you a clear, we'll clearly communicate with you. Once the board has decided, say in July, has the board meeting to announce the first dividend for August. Then when it goes ex, we'll clearly communicate that to shareholders, and then on a regular basis, on a monthly basis, it'll be going ex and broadly getting paid. Obviously there's different days in the month, so shorter months and longer months. But it'll be broadly a similar time each month that A, it goes X, and B, it gets paid.
Thanks, Geoff. And the next question comes from Peter, and it's for Damien. Do you have any comments on the suggestion by some fund managers that the 60-40 portfolio construction is now obsolete because interest rates will be likely to rise over the next few years?
Yeah, it's a great question. We actually put out a piece on this a few months ago, just talking about the 5 Ds of investing, and a big one of those Ds is diversification. So the whole premise about 40-60 or 60-40, depending whether you like equities or bonds more, is the idea that one set of assets will go up while one set of assets might go down, but on average you will win. That way you're meant to get a reasonably good return through the cycle and across years with relatively low volatility. That's kind of the thesis. But underpinning that is the assumption that you've got good diversification, so that when one asset goes up, the other one might not do very much or might go down, and vice versa. Most often, like, the textbooks do not say that this is the ideal way to invest when both are going up at the same time and both are going down at the same time. So the problem that we have in the current environment is that because we have very high uncertainty about inflation, what this means is that bonds and stocks tend to move together more often than not. And actually, you can see this pretty much every day at the moment. What this means then is if you're investing in 60-40 or 40-60 as a passive investment style, not an active investment style, you're watching your portfolio go up and down every day, but there's no offsets within that. It's just either the whole thing is up or the whole thing is down, which can be a bit disconcerting. So what happens in this environment is that investors who traditionally have been looking for diversification to lower the risk profile of their investments, they start saying, well, hang on a minute, maybe I need a cheaper entry point into bonds or into equities, largely bonds, to compensate me for the fact that they're not giving me the same diversification that they used to do. And I think that that's a valid argument. But the question is, well, are there other asset classes that you could potentially be buying to take advantage of the regime that we're in, where bonds and stocks are moving together? And the answer is yes, there are. So one of the alternatives is to pursue something which is a lot more driven by commodities. And the beautiful thing about the Australian index is that we have a lot of commodities type exposure that we can choose from. So that's one alternative, which is really good. A second alternative is actually credit as an asset class. So what you tend to find is that when bonds and stocks are moving, government bonds and stocks, I should say, are moving together, corporate credit, corporate debt typically trades at a bit of a premium. So that's actually a nice little sweet spot, particularly while we're digesting debt sustainability paths and supply and demand factors within the government bond market. So credit and commodities end up being in a bit of a sweet spot to manage and hedge against the fact that you don't have as much diversification. A third option, but this is only really something that applies in rising markets, is to go for smaller exposures rather than large exposures, because the large exposures become very crowded. So I guess what we're saying here is that, yes, it is a problem for a conventional passive 60-40 or 40-60 fund, the fact that we have a lack of diversification. But all that means is that the active manager needs to work harder, and the opportunities to find different investments are ample.
And I guess the important point for WMX is we are a dynamic asset allocation. So 60-40 is our neutral starting position, and we move based on correlations, right, opportunity sets, how things are moving. So again, yeah, when you look at a very passive, like Damien said, 60-40, we are not a passive 60-40. Right. We are a dynamic asset allocation fund.
Thanks, Matt and Damien. Robert also asked a question on this. How regularly do you think those ratios, that 60-40 ratio, will change?
I mean, it's a daily decision. And again, like, it's really a function of markets and how we see them. So we scrutinise it every day. Yep, is this the right decision for the market? What signals did we get? Should we move? Is this noise or is this signal? So it is a daily decision. But again, like, we could try and guess how often we'd move it. But I mean, normally you'd get 3 or 4 big opportunities a year where you can make big tactical bets. But again, it's really at the edges. But we also have diversification benefits within the subset. So within equity, we can change the risk parameters. and within debt, we can change duration. So we do have levers both in the sleeves and with asset allocation. But like everything, we're very active. This is a daily decision. We're working out where we should be positioned, both from a sleeve perspective, but an asset allocation perspective.
Yeah, I think the starting point is always look at the relative yields. Yields are obviously not the only consideration that goes into this. But if you look at the ASX 300, for example, you're talking about a dividend yield which is like 3 and a bit. Whereas you're looking at corporate bonds that are offering you yields, in 5s and 6s. So immediately from an income perspective, you're thinking, well, the income's to be generated from bonds more so than equities. So that's just a starting point. And then obviously you overlay what you think about inflation and growth and policy and things like that, which is all very important and very timely. And those are the events that we have to process every day. And then within the bond portfolio, like a lot of people think that bonds are all about, 10-year or 30-year government bonds. That's not true. We actually have corporate debt. We can choose whether we want longer-term debt or shorter-term debt. We can choose whether we want fixed rates or variable rates. So there's a lot of thought that has to go into that. So the asset allocation decision, although it might print as 60% debt and 40% equities, actually there are asset allocations within that we adjust as well. And this is what Matt was talking about. Within those two broad sleeves, there's a lot of work that we're doing, and we want to get the best out of each portfolio before we actually make a wholesale swing at the asset allocation. We wouldn't be doing our jobs properly if we just change the asset allocation without changing the underlying mix of assets.
Thanks, that's very helpful. And Matt, we have a question from Nick. You mentioned opportunities to invest in companies which may not pay dividends but conduct share buybacks, for example, CSL. How does investing in these companies generate income for the shareholders of WAM Income Maximiser?
Sure. So within the LIC, you can generate income from two ways. Income received or capital gains, and CSL falls into the capital gains side for us, where we think we can make money on the capital gains. So once we realise that, we can pay that out to shareholders. So it's really, we're indifferent largely how that works. We do have a bias towards income, but if there's opportunities within a big company like CSL where we think we can make a capital gain on the stock, we're happy to take that opportunity. And like Damien said, the CSL have gone through a heavy period of R&D. We think that's coming towards an end. We think they'll move to a more cost-focused business model and a partnership model on R&D. So we think this will allow them to have a lot of excess free cash for shareholders. So eventually that will either come back through dividends or buybacks, which is like we said on IPO, we're indifferent between a buyback and a dividend. So that's how CSL fits in.
Thanks, Matt. And Gail has also asked, are you buying the dips in the equity market, or are you waiting for more of a pullback?
It's a funny one. I was going to say we've been waiting for the dip that has never come. The equity market has been very resilient, abnormally so. Even more so the Australia. Like we're seeing I'd call it a dislocation in global markets. In Australia, through no fault of its own, has become the default place to park capital. So the Australian market, we were laughing. It's almost the Stephen Bradbury of the global investment world, where we're still standing, everyone else is falling over, and we've had a lot of capital hit our shores. That will end when things improve offshore, which is a big thing we're watching. Obviously, with the bond markets offshore, with the JGBs, Japan and US, almost unanchored long end of the yield curve, starting to cause a few issues. So, we think Australia is a bit of a safe haven at the moment for capital flows.
Yeah, and I think what you're finding, and this is not just recently, but really over the last 5-6 years, is that you can have days where the equity market has gone up on average, but you'll find that actually a particular bucket of investments could be doing well. Like we saw days last week where the equity market went up, but the defensives outran all the cyclicals. And if you were sitting there as a manager, you'd be saying, actually, that was a down day, right? So the concept of buying on the dips, I suppose, is not just about an absolute call on the market. It's actually got to do very much now with stock selection and sector rotation. So it's actually quite complicated in the Australian context. But the big thing that we're looking for, if you were to experience a major shakeout in the index overall, it would be because you've seen simultaneous weakness in long-term government bonds, an inflation scare, and then maybe some of the related equity exposures sell off with that. The key thing here is obviously concerns about inflation. How high do they get? And then if inflation actually does either not end up not being an issue, or it softens off whatever expectation people have, that will actually create the opportunity then for interest rates to fall properly, which could then obviously support both bonds and equities. So that's kind of a bit of a flavour for what we're looking at. The question that we got earlier about bonds and stocks and diversification, those sorts of correlations are quite key to monitor at the moment.
Thank you. We have a few questions on the IPO for Geoff. Garth has asked, and you touched on this a little bit earlier, Geoff, but will there be a share purchase plan in the future when WMX is trading at a premium, which it also is now?
Yeah, could well be. Could well be. In terms of timing of that, it won't be in the short term, but the plan will be to continue to grow the company. So definitely could be possible.
Thanks, Geoff. And Brian's also asked, given the IPO was less than expected, does this create any problems?
No, actually, to me, it's actually a positive. Positive in from two respects. One is if the market didn't have that volatility and sort of scare a number of people from putting money in, then we probably would have raised the full amount. And we may have well been oversubscribed. And then what happens is you're having people that are investing that mightn't have been fully committed, as I sort of said at the start, the true believers. In terms of the people that put the money in, they're the ones, and this is more a function of the share price in the aftermarket, which, in terms of, the fact that there was the volatility, that has been very positive for the share price in the aftermarket. So there's less supply, more demand, people still looking for income. In terms of actually managing the underlying assets, to me, the fact that we've created this vehicle now, as you've heard from Damien and Matt, it gives them the opportunity to collect information from a significantly wider group of players, both debt players and equity players, and where before we didn't have those entrees into the debt markets that we do now, and with a smaller pool of capital, it's very you can be very quickly utilise that which the guys have. So to me it's. We're not talking, significant quantums. Even if it was double the size or triple the size, then they're very liquid markets. So the money could be, could be, invested very, pretty swiftly anyway. So I'd say, if anything, there's been slight positives from that volatility.
Thanks, Geoff. And the next question comes from Sid and is for Matt. Is CoreVest in your investment universe?
I don't think it's in the 300. I have to check, but I haven't followed it for a long time. So it's not one on our radar. And with liquidity, we do have liquidity as one of our filters. So it hasn't come up. So sorry, I can't give much information there, unfortunately.
Thanks, Matt. And the next question is for Damien from Fang. Most economists and investment analysts seem pessimistic about the US bond market and its inflation outlook. Moody has downgraded the US credit rating. What are your comments on this?
So the thing about the Moody's downgrade is that Moody's was kind of the last to do this amongst a few organisations to kind of get back in line with other ratings agencies. So it's not as if it was responding to, it's not as if it's a new signal, like it's just sort of news that we already knew. and it decided that it wanted to get on board with that. But nevertheless, markets responded to that, albeit in a bit of a volatile fashion, because rightly or wrongly, there are a lot of people that are thinking about the debt sustainability dynamics of the US. They're thinking about the alternatives which are becoming more abundantly supplied around the world. And they're saying, look, maybe a bit of rotation is due. And what you've also seen is that on days where the equity market in the US has been weak, that's actually corresponded with the US dollar falling rather than rising. So anybody who has sort of an unhedged exposure, unhedged currency exposure to the US market is now actually having to rethink how much they choose to hedge that flow, because historically, the US dollar strengthening has been a good shock absorber, but now that's not actually working out so well. So I think these are the portfolio dynamics that are at work. There are some people who will go out very far and say, look, it's the end of US exceptionalism. It's the end of its exorbitant privilege. What I got to say is that, although you want to be paying attention to what everybody is saying at the moment, because it is an uncertain time, you can actually break up the dynamic into smaller bits and pieces. And if you break it up into smaller bits and pieces and add up the story, you can get a dynamic which looks like what we have today. So, for example, in America, there is a very clear issue where the traditional buyers of US government debt are somehow stopped from doing that. So by that, I mean primary dealers or broker dealers. They're basically the first ones that are called upon when the US government issues debt to buy it, and then they can choose to resell it. That's the way the US system works. But because of capital regulations, a lot of these guys actually can't warehouse as much US Treasury debt as they used to be able to. And so therefore, they're not really able to absorb a lot of the supply which is coming online. Foreigners at the moment, what they've seen is it's not so much that foreigners have decided we want to hit the sell button on US Treasuries. That's actually not apparent in the data at all. What you do see is that historically, foreign institutions like superannuation funds and the like have been, and not only superannuation funds, but also central banks, typically when the dollar weakens, they take the opportunity to top up their US Treasury holdings. They haven't been doing that this time around. So passively, they've been sort of lowering their weighting a little bit, but it's not an active selling. So you've got two buyers there. You've got the primary dealers that are a little bit constrained in terms of how they can buy this stuff from a regulatory perspective. You've got foreigners that are a little bit perplexed by the dynamic between US assets and the US dollar. And what that means is that the marginal buyer of US Treasuries is a much more price-sensitive asset allocator. That's what it comes down to. They're the marginal buyer of this extra supply which is coming online. Now, the price-sensitive investor are the asset allocator who is typically investing in a 40-60, 60-40 type combination. And as we've just discussed with regards to one of the earlier questions, the whole reason why you buy government bonds is because they're supposed to be diversifying for your portfolio. They're supposed to lower overall risk. But right now, they're not behaving in that way. So what you find is that the marginal buyer is saying, look, I'm still happy to buy government bonds, but I want to buy them at a much lower price or a much higher yield than what I usually do. So this all looks like, it looks like a bit of a debt crisis for the US and things like that. But actually, you can break the problem down into smaller bits and pieces to say, look, these are the bits and pieces in the plumbing that need to be fixed. And it's just a question of time as to when they are fixed. Now, if you get really, really bearish about the world, and not saying that we are, but if you got really bearish about the world, would we get disinflation, which would then lower bond yields and allow central banks everywhere to cut? Yeah, that's still a very plausible situation. So that's why we look at long duration, and we can see a few reasons why tactically you might see some weakness in government bonds, but ultimately we think that they are a good place to invest at the right price. More importantly, in Australia, as we said before, the story, if the story is sell America, and I'm not saying that it has to be, but if that's the narrative, then the flip side of that is buy Australia. And that includes Australian government bonds, and we have a dovish central bank. So we're actually quite comfortable with Australian government bonds in that environment, notwithstanding some of the shenanigans that are happening in the US. So to summarize that, a lot of people will read into this, it's the end of US exceptionalism. There's some problem with debt sustainability. There is an issue with debt sustainability, but it's not an insurmountable one in the US. They've just got to pull the right levers. The reason why US Treasury yields have been going up more recently, there are a lot of explanations, including some things that are happening in Japan. But the key thing is, remember that President Trump was levying tariffs to try to raise more revenue so that he could use that revenue to grant the tax cuts. Now what's actually happening is that he can't raise as much on the tariffs. He's kind of conceded a little bit there, but yet he's still trying to push through the tax cuts, which could add to the fiscal deficit. So this is the issue that the US bond markets are kind of wrestling with at the moment. It's a bit of uncertainty. And the question is really whether you think US Treasuries are already priced for that risk. And there's a good argument that maybe they already are.
Thanks, Damien. The next question comes from Chris and is for Matt. Roughly 55% of the total dividends are paid by 7 or 8 companies. I imagine he's probably referring to the ASX 200. What proportion of dividends does the portfolio get from WMX in terms of the top 7 to 8 companies?
Good detailed question. Yeah, obviously very heavyweight in the ASX. You know, for WMX, I'm just doing the arithmetic in my head. It'd be around 10% of the total outstanding fund would be in those companies. Very tactical decision at this point in time. That's not don't draw a line in the sand and say that's what we're going to have all the time. But you know, we did invest in NAB and Westpac very tactically around some of these dynamics on fund flows. So we have picked up those dividends. But again, you know, we're not constrained by dividends. So although they do make up a large proportion, you know, we'll take tactical opportunities around those dividend periods if we think there is a fundamental case. If there's no fundamental case, we will not pursue those. So again, we're happy to get our dividends and not be restricted by where the big heavyweights are coming from, because the heavyweights is really just a function of obviously the market cap as well, and the impact it has on the index. So yeah, we're happy to chase income in more reasonably priced companies.
And the other thing to note as well is that, I mean, we do have 60% of our portfolio currently in debt, and most of that debt is, of course, bank or financial debt. So if you kind of take a holistic view of all of this, then actually we're getting a fair chunk of our income, not necessarily dividends, from some of the larger names, yes, but it's diversified across debt and equity.
Thank you. And Bob has asked, could you list your major holdings of equities?
I'm not sure if we're allowed to do that. We can sort of talk through the
sectorally. We can.
Yeah, I mean,
well, or is it a question to list them as in? Does Bob want them listed now, or does you want them listed, you know, when we announce? I know we announced our NTA the other day, just an update one, but not a detailed one.
I think he might want them now if we're able to, but if we're not able to, of course, we'll put them in the NTA update.
I think we can tell them the main ones.
We can rattle off a few. I mean, you know, IAG has been one we're pursuing. They had a good win with ACCC today. That's sort of you know, a good core holding. With CSL, we think they'll get a favourable outcome with the tariff situation in the US. You know, we've got Rio Tinto, as Damien mentioned. You know, we've been playing around in Goodman Group. We got the really big bounce in Goodman Group, but it was in the mid-20s. That's been a very good holding for us. Other ones, you know, BHP, we've put a position in BHP.
Woodside.
Yeah, we had some Woodside when that got down to the low or below 20. Energy was oversold. We've put a little bit of, we had some NextDC in the portfolio too. That was more of a tactical trade. Other ones would be, we've had some, you know, James Hardie's from a tactical point of view as well. That's not so much from an income point of view, but we think there's a capital opportunity there. It's been depressed and very much out of favour, and fits in with our long duration. We're actually positive long duration, not now, but like in the very short term. APA is another staple, I should say, that we've had in the portfolio for a while. Transurban, SCG, Mirvac. that's probably a good little flavour of what's in the portfolio at the moment. The main drivers, Westpac and NAB were in there as well for a period and still are, but we've been progressively winding those back.
Thank you. And for Damien and Matt, Hilary has asked, how will the higher percentage of debt in the portfolio impact franking?
It doesn't really matter from a LIC point of view, like the way we generate franking. Obviously, dividends on the equity side come with franking, but we do have around 10% of the portfolio in hybrids at the moment, which we've bought the longest dated hybrids because we think there'll be a scarcity premium to these eventually. So we get franking. So we're getting franking from about 50% of the portfolio. The other 50%, the franking we get is when we get interest coming into the vehicle, we pay tax on the interest, so we can pass that out as franking. So it's really a combination of all those things and capital gains. If we make money buying or selling equities or buying and selling on the bond side, we can actually pass that through as well and frank that. So there's multiple ways we can frank.
Thank you. Gail has asked, is it fair to say that Matt manages equities and Damien manages debt?
No, it's very much a joint.
Interactive.
Yeah. It's, we both have views. Quite often they are the same.
Yeah.
But no, it's very much a dynamic process. There's no one's got a strict mandate to do certain events. I mean, we discuss everything, and we've got the team, all the investment professionals as well. We've got the global team, the domestic small mid-cap team. We've got the alternatives team. There is a breadth of experience there. We've got a very active board as well. So we have a huge amount of input. But no, we both manage it, and with help from Anna as well. So, yeah, it's very much no one's got a strict mandate to manage a bucket.
I mean, I think a good way of thinking about it, again, to go back to the question before about diversification, suppose that we were siloed, right? Not saying that we are, we're definitely not, but suppose that we were siloed. If I were to say, okay, I want to buy long duration government bonds, then the natural question would be, well, we have some allocation towards equities. How would we position our equity portfolio consistent with that? And that requires a lot of discussion. Do you go for the things that would rally in a rising market because bonds are rallying, like long duration growth, technology, that sort of thing? Or do you say, no, it's actually because the economy is slowing, we want to have a bit more emphasis on quality and duration? Do we want to go the levered end of that in terms of infrastructure and utilities and the like, because we think credit spreads are narrow? So there's no, I guess what I'm saying is that there is no way that you can just silo the information in one spot and do a multi-asset portfolio justice. You need to be very holistic and actively engaged with it. Even if you have different views about where things go, maybe there's diversification in that. So this is something that we really try to understand on a daily basis. And as Matt has said before, when you are managing actively, when you are looking at the signals daily, you will change your mind on certain things, not because you've made a binary decision about whether something is yay or nay, but actually because the balance of risks, the probabilities can change, and everything needs to adjust to reflect that.
Thank you. The next question is for Matt, and it's from Sally. She says, thanks for the webinar. Fantastic result post-IPO. Great work. Prior to the IPO, she understood that the equity field would be the ASX 300, and today it was mentioned that it's mainly the ASX 100. Has there been a change of focus here?
No, definitely not. I mean, the universe, what we screen is the ASX 300, but again, the screen lends itself towards high quality, and with high quality generally comes size as well. So we find there's a bit of a bias towards that, but it certainly hasn't changed. It's the same investment process we came out with. And again, like Damien mentioned there, we will go where we think we can make the most money as well. So at the moment, there's a heightened level of volatility. So quality will win every day of the week. When maybe the environment is different, rates are lower, the volatility is suppressed, we may go out towards the 200, 300 and find opportunities there as well. So again, it's very much determined by market situation. So it's no deviation at all. It's still exactly the same as we said.
Thank you. The next question is for Damien, and it's from Andrew. With the RBA in an interest rate setting in a downward trend, and keeping that in mind that the RBA had the interest rate set below 3% for 10 years between 2012 and 2022. Is there a short to long-term prediction for interest rate settings? This baseline will make an income product more or less attractive.
Yeah. So let me break that up into two components. The first one, in terms of where interest rates settle, we believe, and pretty much the market thinks the same thing, that a neutral level of interest rates for the long term is around 3.5. So when does the RBA deviate from that? It deviates from that when it's clear that the economy has been growing for a sufficiently long period of time below its potential to free up spare capacity, to bring down inflation, and so on and so forth. So the RBA is basically telegraphing a view that it expects quite a decent slowdown in the Australian economy that would free up spare capacity, that would bring down our inflation, certainly lower to what you might see abroad. Now, there's a bit of uncertainty about that because a lot depends on essentially how you see the low Aussie dollar feeding into an overall assessment of financial conditions. So there is uncertainty, and that uncertainty could be resolved in a very positive way for the economy, as the Buy Australia thematic is suggesting, or it could still be very much as the RBA saying uncertainty weighs on economic growth and sentiment and all of those sorts of things. Now, the reason why I mention uncertainty is because the shape of uncertainty, not the level of interest rates, determines the demand for value versus growth. So value is very much in the camp of income because it's much more short duration in nature. And then growth is much more long duration in nature. And the way it actually works is if you have a fundamentally high level of interest rate uncertainty, that more so than high rates will stop you going out and betting on longer term payoffs and long duration growth. Whereas if you have a lot of uncertainty about interest rates and the valuation of future cash flows for companies, it actually naturally biases you towards shorter dated things that you can see and touch today, income and value and so on and so forth. So what I would say is that the long-term neutral rate's 3.5. We're navigating incredible uncertainty, and the uncertainty is primarily emanating from interest rate markets at the moment. And so what that will naturally do, irrespective of where you see the RBA moving the cash rate up or down, predominantly down, is it will continue to bias investors towards shorter duration income. And even if bond yields were to fall from here, they would be falling in such a way that they're reflecting a slower growth environment, which would favour quality. So we think that quality and income are actually pretty good attributes of a portfolio to have. Never mind what's actually happening with interest rates per se. Obviously you want to get a decent hurdle over the RBA cash rate, but the demand for income should still be there because of the fact that we are in such a highly uncertain interest rate environment. That's even without making a call on where interest rates end up going. It's just saying that there are very wide bands around that neutral rate at the moment. And that's just reading the lay of the land.
Yeah. And I'll just add the period from 2012 to 2022 was really the aftermath of the GFC too. So I'd probably call that period abnormal.
Yes.
As far as interest rate settings, as the world was healing and excess liquidity. So again, that's probably not the greatest comparison for Aussie long-term rates.
Yeah. The in the jargon, to quote some jargon, so if you have a long-term neutral rate of 3.5% and the 10-year bond yield is, say, tracking at 4.5%, then what we call that is a term premium. So you've got the difference of about 1% is the extra compensation that a fixed income investor would need to pay off the fact that they're taking on so much uncertainty. So the market pricing is telling you that even if the RBA cuts rates, it's not at all clear that that spread has to come down because we are so uncertain about the world of interest rates and inflation. That's actually the sweet spot for income investing, irrespective of which way rates go.
Thank you. And the next question is for Geoff from Stuart. How would unrealised capital gains impact investments in WMX?
Stuart, you've been paying attention to the debate after the election. That's right. The appalling, what I think Jerry Harvey said, stupidity of the highest order. You're sort of warming me up this late in the webinar. about how bad the policy to tax unrealised gains, tax a profit that you may never make in superannuation. Now, that's purely in superannuation, and it's for on balances over $3 million. So the tough thing is it's not indexed, so eventually everyone who works will be paying it. And it's, it's just illogical. It's a bad policy, as some people say. It's criminal. That won't impact us at all, because it's the people, the taxing of the unrealised gains in superannuation funds, and if anything, this is actually a perfect product to invest in, which is giving you a high yield, and you're getting sort of a high yield and with less risk, and potentially more yield than capital growth. So to me, that's what people will be looking for, because you can't take the risks you used to take if this policy comes in. Particularly if you're a little older like myself, not like Damien and Matt, or April, a bit younger, then you can ride it out. But when you're a little bit older, then why would you take the risk of, we've seen during the GFC, the market falls, is it 55%? COVID market fell significantly. The crash, the 87 crash, market fell significantly. You don't want a situation where the market goes up, you pay the tax on the unrealised gain, and then before you sell anything, the market falls. So what we think is probably $1 trillion, 1.1 trillion that's in self-managed super funds. They're going to change their asset allocation, go away from supporting startup companies in Australia, sort of the lifeblood of Australia. They'll go away from that and go to high yielding products. And this is probably, Damien has been alluding to that all along in the early part of this discussion, is there's a lot of demand for high yielding products. And so this fits perfectly if this legislation goes through. Now, we're hoping that sanity prevails, and please, we'll send an email out in the next week to all our people that are signed up to the Wilson Asset Management emails, just about our current strategy on this. We've been very vocal, but thank you for bringing it up.
Thank you. And Geoff, we have a question from Digby. Is it more expensive to pay monthly dividends with the share registry administration and postage costs?
Yeah, it is. But unfortunately, there's in terms of postage, we're not sending checks anymore. So the efficiency is a lot better than it was historically. It is obviously, if you pay one dividend once a year, it's cheaper. Paying 2 dividends, the interim and full year, is again cheaper than paying monthly dividends. The actual cost is for a company that's, we're talking about $150, $160 million company here. It's dollars in terms of costs, or cents in terms of sending the dividends out. So it's not. You'll find it very hard to see on the any major difference on the profit and loss.
The next question is for Matt and Damien from Simon. Do you employ a dividend harvesting strategy to actively trade a stock during its come dividend period, with a strategy to take advantage of any short-term pricing anomalies where a come dividend share price reflects a premium or discount to the theoretical ex-div pricing?
No, we don't really actively employ that strategy. We did look at it with the major banks, whether we would do that. We ended up holding them, like I said, NAB and Westpac post the result leading up to the ex-dividend period, but it was more on a flow perspective rather than a dividend stripping perspective. So it's not something we would regularly employ. Would we do it potentially every now and then if there was an opportunity? But I wouldn't. I classify it as a minute part of the strategy, if at all. The practice of doing that. We think we've got a model which we don't need to do that.
Thanks, Matt. And we've got a question from Chris. If the market surprises us and keeps gently rising, will the 40% in equities get hurt against the benchmark of 60%? And will the difference be made up by the overweight versus the benchmark in the current 60% in debt?
From a benchmark perspective, yes, we would get hurt. I don't think you could overcome that from a benchmark. But again, we don't really manage for a benchmark. We're actively trying to work out what is the best decision for shareholders at any point in time and how would you position. So we don't really I shouldn't say we don't care about the benchmark as such, whether we beat it. And, obviously we want to beat the benchmark, but like our decision to be underweight equities, we think is the right call. But yeah, from a benchmark perspective, it would hurt, obviously, being 20% underweight. Could we make that up on the debt side on market movements? Highly unlikely because of the quantum, the way equities move versus debt, it'd be highly unlikely. We could offset it with, we're doing some things now. We're overlaying the bond portfolio with some govy bonds. So we're actually extending some duration into this rate swap. So, we are managing and hoping adding value through an overlay. But again, it'd be quite hard on a 20% quantum to really overcome that movement. But again, we're not stuck at 40% equities. If we get signals, and we're looking for signals every day, every minute to move towards equities, we will. But yeah, that probably anything you'd comment on?
Yeah, so once again, it comes back to that question about bond equity correlation as well. So under what situation could we see the equity market really rallying from here, even though it's had an extraordinary run from the lows? And overwhelmingly, the signals that we follow, whether it's the actual correlations or whether the leading indicators, like inflation uncertainty, what they are telling us is that bonds and stocks will remain joined at the hip for a while. So if you think that equities are going to rally, you also have to have the view that bonds will rally, long, and in particular led by the long end. On the flip side, if you have the view that long duration government bonds, so a very specific segment of the bond market, will sell off, then that will naturally weigh on the equity market as well. So where we're actually positioned at the moment within bonds, although it says bonds 60%, the weighted average maturity of that's closer to 2 years, not 10. So we actually haven't taken a tremendous amount of duration risk just yet, although we have made some tactical adjustments. And by and large, what we are positioning for is that the spread of corporate yields relative to government bonds compresses, because if that compresses, that's capital growth for us. That's kind of where we're positioned at the moment. So what that's saying is that we see some risk that in the short term, you could see long duration bonds sell off, which would actually be bad for equities. If long duration bonds don't sell off and they actually rally from here, it's because the inflation outlook has dramatically improved. That is, inflation has come off. But where we would make that up on the debt portfolio is that the credit spreads at the moment, which should be reflecting uncertainty, would compress dramatically. So this is what Matt was saying before about we can actually put through a lot of adjustments. It's not just about straight government bonds versus equities. We have to consider the interaction between them. I suppose the question really is, do we think that inflation is a non-issue here? And with all of the things that we're seeing with tariffs, potential supply chain disruptions, US dollar weakness, maybe China stimulating and pushing commodity prices up, I don't think it's wise at the moment to say inflation is just going to drop. And so that means then that automatically we're not going to be inclined to position for bonds rally and equities rally. It's just not going to work that way. So that explains a little bit of how we're thinking about this at the moment. But, as Matt said, we're open to changing if we see some signs that the things that we're following are changing. But hopefully that gives a bit of a flavour. We don't think we're going to be caught short by this allocation, in short, given the way the different markets are moving.
Thank you. And while we're speaking about debt, Peter has asked, can you explain how you decide on the quality of the corporate debt you take on? Is it all deemed investment grade, or are you more adventurous in your choices?
No, it's all investment grade.
Yeah. So yeah, just on how do we select it? Obviously, we look at the underlying issuer, the demand, the spread over swap. Are we paying a fair spread over swap for the company? And the beauty is we have intimate knowledge of all the underlying companies for decades within WAM of the companies doing the issuances. So yeah, we've been pretty vanilla in the investment grade, but again, that's been the right place to be, and especially at the tier 2 level, where you're picking up a nice little carry on the senior secured. So we think the tier 2 is the place to be, and the major ones we've got are all the major banks. We've got Macquarie. We have got some small amount of HSBC, which is denominated in AUD, so a Kanga issue.
Yes.
And there's quite a lot coming now into Australia, as we talked about. Australia is a destination for capital at the moment. So, we're getting plenty of opportunities, and we're always looking to try and pick up a bit of a spread over swap when we can, and we think it makes sense. But yeah, we've just been very much in the investment grade side. But there's always opportunities on the trading side as well. It's not just set and forget. We can swap between different lines. Different lines will get capital flowing into it, compress spreads. We can move them out. So there's been a surprising amount of opportunities we've had to look at on the debt side as well.
At the end of the day, the way the market is trading and the way it will continue to trade is that if you think that there's a lot of risk in government bonds, then people have got to be looking for safe havens that are not government bonds. And when you're talking about Australian corporates, which are pretty well capitalised, a country which is attracting a lot of inflow because it's superior rated to a lot of other countries at the moment, I don't think there's much of an issue in that space. Are we actually, the question would be, have we right-sized the amount of credit exposure that we have? And we think we have. So that's from that perspective. And back to the point about quality, we look at obviously the aggregate credit ratings. So anything which is below triple B minus is no go. That just wouldn't be investment grade within our mandate. We think Australian companies, the larger ones in particular, they're all fine. But they are fine on the rating system, but they are fine even on our judgment. And remember that we can triangulate as well. So we're looking across equity and debt portfolios. So typically the stuff that we think would actually be a quality name in the equity side, that would be a pretty good leading indicator as to what would be quality on the debt side. So we're pretty comfortable with the process that we have for screening quality companies on that side.
Thanks. And Damien, Shane has asked, and you've touched on this a bit before, but have you or are you taking advantage of the movements in the bond markets, and has the timing of these movements benefited investors?
Yeah, absolutely. So, when we deployed, it was just in the wake of all the Liberation Day damage, or as a colleague of mine has said, April Fool's Day +1. So, when you see that sort of opportunity and spreads have actually gone out, the question is, is that an attractive enough spread to get in? So the time that we were looking at, you could easily get high quality corporate debt for over 210 basis points relative to government bond yields. So that's a pretty attractive yield. So obviously the time that the fund is launched is around that time, so we can take advantage of that. And remember that our benchmark is short duration. So as we've been deploying, we've been trying to get the average portfolio duration to about roughly 2 to 3 years. What you've seen recently is that the long-term government bond, 10s and 30-year government bonds, have started to really sell off. But we're in the short end, so we're not really feeling the impact of that. So that's actually creating yet another opportunity for us. Actually, the timing has worked quite well when it comes to interest rate risk in terms of the deployment, and then also the next opportunity to come along.
Thank you. And the next question comes from Ian. Will you be advising shareholders of the individual equity investments periodically? And perhaps Matt or Geoff could touch on that.
Yeah, still in the process of working out what to include on the NTA, so we don't have a definitive answer for you yet. We're open to suggestions, though. I mean, initial thoughts was, very much aligned with the other funds where you might do the top 10 or, can we give more? Still undecided. It is a work in progress. And again, we're happy to take suggestions on preferred formats. I know everyone would like the whole list, but we don't like giving the whole list quite often because it's just showing our competitors and brokers what we hold, which is an information disadvantage for us. But, we try to give the most exposure we can to the portfolio. So again, it's an active decision, talk at the moment of what we do, but we don't have a definitive answer for you yet.
Thanks, Matt. And the next question is for Geoff from John. Are WAM Income Maximiser and LICs in general constrained by the 45-day franking credit rule?
Yes, like everyone. Yeah.
Great. And Matt and Damien, Ashley has asked, as Income Maximiser will pay dividends monthly, yet most companies pay their dividends 6 monthly, is there a risk of dividend stripping by traders in this portfolio?
By traders. I'm thinking you mean by the retail shareholders on WMX or like, no, I don't think so because, I mean, that's the companies, the equities pay semi-annually, but we've got a whole lot of quarterly coupon payments on the debt side as well. So again, in these first few months, we're building up the buffer. The dividends are going to be progressively winding up. So our buffer will be very much building in the background. So I don't see that as an issue around dividend stripping on WMX, and because you're always essentially come dividend too every month. So, once you pay the dividend, you effectively come the next dividend anyway. So you probably won't see as much dividend stripping on the WMX share price as maybe other funds.
Yeah.
Thank you.
Particularly floating rate notes in Australia, like the fixed rate notes on corporate debt are semi-annual. But again, we're largely short duration, so we hold quite a significant chunk of floating rate debt, and they're quarterly payment, and they're staggered in their quarterly payments. So you will have one that pays in January, February, and March, and then the same sequence thereafter. So it's not too much of an issue, but precisely because we have the debt portfolio running in the background.
Thanks. And Bill has asked Matt and Damien, what Australian corporates are you buying or interested in? And I think he must be referring to the debt side of the portfolio.
Yeah, so Matt's already alluded to some of the names. So when you're in tier 2 debt markets, you can't really go past the major banks. Like you have to have them. That's where the major exposures are. And, particularly after Liberation Day, some of the spreads that were being offered on that stuff, floating rate, long, but a note that will exist for some time, they were pretty good, pretty attractive for the quality of the businesses that you were getting. They were really good. And then you can think about would a Macquarie fit in that category? Well, it's a little bit riskier, but it's still sufficiently investment grade, and its spreads got really attractive. Then there's not a lot of diversity within the financial space. But then you look at a name like a QBE, which we're happy with insurers on the equity side. So why would we not be happy with them on the debt side? And they are a quality company, sufficiently defensive in our view, rightly exposed to the macro economy and offering a great spread over government bonds. So that's kind of where we've been. Some of the kangaroo issuance, like say an HSBC, where it's a foreign company that's issued into Australia, that was very, very attractively priced, and the spread has come right in. So there's actually quite good capital growth on that one. So that gives you a bit of a flavour. It's predominantly financial because that's the nature of the issuance. But within the financial space, there's actually a lot of opportunity to actively manage and take advantage of tactical opportunities. And we believe we've been doing that.
Thank you. And Ian has asked, do you have Evolution Mining, the ticker is EVN, in the equity portfolio?
No, we don't at the moment. Like we were looking at not for a dividend trade, for a tactical trade, but more of a, it's all linked to, as you've seen with gold price and what's happening in the market. We did think about putting some gold exposure into WMX, but we didn't. Other portfolios have had EVN in the portfolio. It got a nice kicker as well from an index inclusion. So, more broadly, our view on gold, we'll probably think it's done a lot of the hard work, and less constructive on gold from here. There is a path where gold does very well, and that's still very much live. So if you believe in that path, I mean, there is an opportunity. But like from us, we think it's probably from a probability expected return point of view, it's largely done for now.
The thing about gold companies is that buying them because they're cheap isn't always a great strategy. Typically what you find is that the gold price needs to be rising. And of course, because these are Australian companies, then it needs to be rising in Australian dollar terms in order to keep gold stocks just on an even keel, let alone grow their capital. If you're taking a view on gold at the moment, you're really saying, if you're a bull, that it's the end of US exceptionalism, need for alternative safe havens, which could include gold. But if you think there's any risk to that view, that is that there are things that the Americans could do to steady the ship, and there actually are quite a lot of things that they could do, then that would be a bit of a downer for gold. From a tactical and positioning point of view, gold is just the standout performer. So whatever your view on gold, you just have to come from the starting point that actually it already has done very well because a lot of investors have preempted a lot of the things that are going on right now. So the question is, will the news get even more favourable from gold, incremental to the discussions that people are currently having? And that's a much harder discussion.
Thank you. And while we're on the topic of gold, Cole has asked, he said, I see the biggest equity investment to date has been immaterial. Would they mainly be in coal or gold? Maybe touch on views on coal and whether it's held in the portfolio.
Oh, okay, so materials investments.
The sector.
Yeah, so the sector, I mean, predominantly it's been led by Rio Tinto. We've got a fairly favourable outlook on aluminium. Also, the acceleration of resolution project in the US is a positive and will force a little bit of discipline around Rio Tinto as far as resolution is such a big project for them. They do not need to do any further M&A outside of the small lithium deal they've done. So we think the growth outlook for Rio Tinto is firmly in track. There is strong discipline now. They don't need to chase growth. Damien touched on it before. China, we think, will come out with some sort of fiscal stimulus in July. And again, some of the underlying, the commodities now, like this is very short term, but even last night in a market sell-off, we had commodity prices generally pretty firm. So it's a bit early to call a trend, but maybe that trend of commodity weakness is over now. Obviously there's a whole lot of risk factors, which we all know, which could affect it. But, the balance, again, we go back, everything's probability, expected returns. They haven't done much heavy lifting post the, pre-Liberation Day. They sort of obviously got a benefit when there was a China tariff truce. But yeah, I think that's one area where there's still some upside. It's mainly in Rio Tinto, a little bit in BHP. We put a little bit of South 32 in as well. Sub $3. Guinea have been shutting down some alumina mines again. Bauxite mines. So this could create a bit of uncertainty in, with the alumina price as well. So we saw alumina price spike 6% the other day off the back of some of these Guinea mine closures. So again, this happened last year actually, which flowed into this early this year. Alumina and prices went through the roof. So again, this is favourable for South 32. So that's a little bit of colour around the materials position in the portfolio. No coal, no gold.
The thing about investing in commodities at the moment, there are a couple of things that are worth highlighting. If you look at what individual commodities are trading at, but not in US dollar terms, in gold terms, you'll find that a lot of the commodities that we export, whether you're talking iron ore, copper or oil, they're really, really low valuations in gold terms. What that means is that there's plenty of opportunity for these industrial commodities to outperform gold. The second thing is that if you look at what's happening in the world at the moment, so the US dollar has been weak. It's continuing to weaken now. In a world which is globalized and connected, US dollar weakness typically makes it a lot easier for emerging markets that are pegged to the US dollar to stimulate their economies. And so typically what you find is that whatever the US is doing will add to that if the US dollar has been weakening, because everybody else will be able to stimulate. So if you have the view that the world holds together to some degree, like maybe with a bit of sticky tape, and you've got US dollar weakness, you should actually see China stimulus. You should actually see all of these things contribute to stronger demand for industrial commodities. If, on the other hand, you have the view that actually, there is some merit to the end of US exceptionalism and the US dollar is going down, but it's not necessarily a favorable environment for world growth, granted, you might see the gold price rise. But again, because you've got so many industrial commodities that are actually cheap in gold terms, if you think that the gold price can rise, well, valuation can continue to lift these, particularly if the response to a decoupled world or some loss of US exceptionalism is that another country decides to take on the baton of growth, like, say, China. So actually the balance of risks here is skewed towards industrial commodities doing better and certainly doing better than gold.
Thank you. And Alice has asked, can you please explain the growth to fully franked dividends to someone who is new to this process? In terms of the dividend.
Yeah, from the WMX perspective, I mean, effectively a new LIC, you need to obviously build up the income, like for this product, the income received, and also some of the capital growth, lock that in as well. So, I mean, the idea is to progressively pay the dividend out. We'll build a little bit of a buffer and then progressively wind the dividend up. I think on the roadshow we talked about by the end of FY26 we'd be at the run rate. But again, we've deployed ahead of time. So again, we'd have to, it'd be a board decision. They'll sit down and model it. We've done the modelling. We think we're in a very comfortable position to run that dividend now. So again, we think it's going to be, the way we talk about it is progressively wind up the dividend. So again, you can't come out and pay the big dividend straight away. You build the buffer. So, I mean, when we talk about that, I mean, that's essentially what we're doing is building the buffer, pay a small dividend, then progressively wind the dividend up to the full run rate. And that's just dependent upon where the market sits at any given point in time. But again, we've invested ahead of the curve. So again, that should flow through earlier than we expected.
Thank you. And the last question comes from Bala, and it's for Geoff, Matt, and Damien. Do you personally invest in WAM Income Maximiser?
Yes.
At IPO price of $5 million.
Yep.
So we're all,
I wasn't quite
we're all
expecting.
You're going to build up. You'll end up being. You'll live longer than me. You'll have more money in there than me.
Yeah. No, I've unfortunately I put in. I think it was $75,000, but I just finished building a house, so I'm a bit cash poor at the moment. I would have put a lot more in there if I could have, but definitely invested and would be adding to it at suitable times because I obviously we believe in the product and
yes.
I think it's a great. Even for myself, I'm just going to get the DRP ticking in the background. Like I don't need the cash right now, but for me, I'm just going to get the DRP, reinvest, and build it up over time. And I see it being a core holding of mine. Along with some of the other WAM products. And yeah, for me, it's a great product and a diversifier away of risk for myself as well.
Absolutely.
Look,
Thank you.
And thanks, guys. I think you said, April, that was the last question.
That's right. Yep. Handing over to you, Geoff.
No, thanks everyone, and thanks. There've been some really good questions. You're aware this is your company, so if you have any other questions, please email them, text us, call us, ring the office. or use the old-fashioned method, write a letter. But we'll get back to you. So thank you very much. In terms of this call, you'll get a recording. Will be up on the website shortly. So if you want to re-listen to any of it, I mean, and you can hear it from how we've been talking about WAM Income Maximiser, that we're very excited about the outlook and how this company continue to grow and prosper, and really as a company for the times. We talked about something that's very topical after the election, is that tax on unrealised gains. Well, to me, WAM Income Maximiser fits in beautifully because it's giving you a high growing yield, and a lot of the the horsepower is going to go in terms of delivering that yield to you, rather than and it'll also give you some capital growth, but really a lot of it is in yield. And please, if you do have any feedback or ideas, and even once we do the monthly NTA, if you have any thoughts or ideas about how we should change it, please feed back to us, because you guys, you've come up with some great ideas. I mean, the reason why we've created this product was actually feedback from shareholders, and we think it's a really exciting growth product for us over time. So again, thank you on behalf of April, Matt, Damien, myself, and everyone at Wilson Asset Management. Thank you very much, and look forward to seeing you, speaking to you soon.